It's all bullshit. It's all talk from bankers. It's all talk from analysts. And no, this is the last breath of the unbacked fiat global monetary system. And it will never go to a gold backing. It will go to gold and silver, but it won't be a backed system. It's trust and faith that's dying. If it's backed, we're going to back the dollar with all the gold in Fort Knox, nobody would give a shit. It's trust and faith. We don't trust you anymore, United States of America. You screwed us.
Hey, Freedom fam. Welcome back to the Pebbleton Post, where we create conversations that help you navigate the change. I'm your host, Josh Lake, and I'm here today with Bix Weir, who is, as you guys know, one of the key thought leaders in this space when it comes to all craziness in the markets. And that's what we're going to be talking about today. We're going to be talking about FDIC. We're going to be talking about the Fractional Reserve Banking System and just how all of these issues that are starting to pop up more and more are affecting all of us. And so before we hop into all that, Bix, how are you doing today?
I'm good. I'm busy. It's like all the stuff I've been talking about for the past 25 years is coming true. And everybody's like, oh my God, I can't believe it's happening. I'm like, what the fuck are you talking about? It's been 25 years of me screaming about it.
That's what it takes for people to start listening, is when they start seeing it in their own bank accounts, when they start seeing it on their own news channels. And so it's starting to happen, and hopefully more and more people are starting to listen. So thank you for all you do on that space too, because people have to see what's going on. And I really started to see it with this whole SVB, started to see it. I mean, we've been talking about it for a long time now, but it's starting to really hit the mainstream. I'm starting to have these conversations with my friends who are not connected to this space at all. So it's definitely exciting times, and really excited to hear what you have to say about everything going on.
Cool. Let's do it. Let's dive in.
All right. Well, first of all, I think just to let people know, your money in the bank isn't really there. And the reason it's not really there is because of this thing called fractional reserve banking. And if you don't know what that is, it essentially means that as soon as you put your money into the bank is going to lend that out 10 times what it has. So the money that you think you have is being lent out. And then those people who get those loans also are putting in other banks, and that's being lent out. And so there's really, truly, and please correct me if I'm wrong, the money in the bank that everyone thinks they have is not there. And if enough people went in to go actually get that money, it would create an insolvency. And that's what we were talking about with SVB. That's what happened, at least partly what happened. So do you have any advice or any just thoughts on this whole system? I know you do, so please let me hear them.
Absolutely. Go watch It's a Wonderful Life. It breaks it down into the basic concept of, why does the bank pay you to hold your money in there? Why do they pay you interest when you're holding your money at a bank? What's the idea? Why does the bank want your money? If they're just going to hold on to your money until you're ready to pull it out again, that's a horrible business model, and they fail instantly. So what was created back in 1913 with the Federal Reserve System, it didn't start out at 10-1. I think it was like 40%. They only had to have 40% of what they promised in the accounts, so that at such time as people came to withdraw their money, it would be there. Now I didn't even know if you count derivatives and things like that, it gets a little squirrely, but it's about 10-1, 11-1. So that means that every dollar that a bank receives, they can lend out $9 or $10. And that's how money's created in the United States. And when they lend this money out, there's short-term loans, there's medium-term loans, and there's long-term loans. Long-term would be anything over 10 years. And historically, the way banks do, they factor in, okay, how many people are going to pull their money out over time? Obviously there's times of economic stress in a business cycle that you're going to want to have more reserves so that people can bring their money out. And the key is, you don't want to be in the news. You don't want to be part of the news cycle that says, is there FDIC insurance at this bank? And is your bank, or is your money covered, and things like that? That's the worst thing that can possibly happen to your bank, and especially to the FDIC, the Federal Deposit Insurance Corporation. They were invented because there were runs on banks, in the past, and they didn't want that. They wanted everybody to be secure, so they invented this FDIC, which is supposed to ensure a certain amount of bank deposits throughout the entire banking system of FDIC banks. But there are limitations to that, and we can get into that. But that's the idea: is no bank has all their deposits just sitting there doing nothing. They have to put them out and work for it, because they have expenses too. I mean, they got all the bank, the IT is a huge expense now, but they've also got their local branches and the cost to run their systems and the corporate costs and the cost to pay their executives and all that. So yeah, no bank could survive a bank run, meaning that if people run into their bank and say, I need my money, that's fine until you get to about 9 or 10% of those people running in and get it. And then all of a sudden they start freaking out because they're going to have to start selling off assets. And if all the banks are doing it, they're all selling the same assets at the same time, and it gets really ugly.
And the FDIC is aware of this whole situation. That's the reason why they exist. And you shared a really good video recently, which I'm going to pull up right now, where the FDIC board had a meeting. I'm not going to play the audio because we're going to talk, but where there was clearly an awareness that this was all happening, and they chose not to tell the public that these banks, pretty much all banks, are insolvent. Is that kind of what the gist of this meeting was, or do you have anything to elaborate on that?
Well, the banks are not insolvent. Insolvent would mean that they had to recognize all their losses and they have nothing left to pay out the depositors. An insolvent bank might be, they don't have to be insolvent for a bank to shut down either. It might mean, like Silicon Valley Bank, you just don't have the cash to give people who want to withdraw their money. They had the investments. They clearly had a lot of investments in U.S. Treasury bonds and mortgage-backed securities and things like that. And because interest rates were held so low for so long, people had to find different investments that will pay more than 0% interest that they could get from holding money in a secure facility or with a bond, a treasury bond. So they go down the list of, okay, this is kind of secure, this is sort of secure but pays more interest, this is not really secure but pays a lot of interest, and banks basically mix and match to that criteria. In the case of Silicon Valley banks and a lot of these banks now, because interest rates raise so fast, all their long-term safe deposits that they put out, the money they invested in long-term bonds and mortgage-backed securities, all those are going underwater because everybody in the system says, I don't want to buy that anymore because this pays me 5 or 6%. And this, if I held long-term safe bonds, pays 1 or 2%. So the face value of that bond might have been, $1 million bond, but you can only sell it today for, $850,000. And that's the way interest rates work. And if it went in the opposite, the higher interest paying bonds would be more attractive. So when the interest rates are going to start diving, those high interest rates bonds are really going to kick in. And then nobody's going to want to buy the new bonds that pay no money. And all this falls apart when people come in and say, okay, I need a certain amount. I want to get my money out of the system. All right. The economic system is changing. A lot of big guys went into Silicon Valley Bank, Peter Thiel and Jamie Dimon, and said, all right, everybody who's got money here, get it out. I mean, That's a recipe for disaster. And I don't know if I don't think it's illegal. It's just stating the obvious. The banks don't have the money they say they have.
Mm-hmm. And so I've heard too, when you're talking about these bonds, that one of the markers for the economy is the yield curve of these bonds. And when typically, historically, the long-term bonds are the ones that are going to be more safe, like you said, or profitable. And the short-term ones have higher risk. Is that correct?
No, longer term is higher risk. Short term, like overnight money is the cheapest money you can get.
Yes.
So it depends. Are you buying bonds that somebody else holds? If you're buying bonds that somebody else holds, you want high interest paying bonds. So those will be more valuable than the low interest paying bonds. So they'll basically, no matter what the face value is, people are going to look at the remaining value of that bond, how much interest they pay over time, present value it all back to the start, and say that's the true value of the bond. And if you can make 5 or 6% interest now on a new bond, you want to buy that. You're not going to buy the old piece of shit. So when someone like Silicon Valley Bank, who has to sell off assets to meet deposits, starts selling, nobody wants to buy them, and it even drives the price down even lower.
Okay, so that's what we saw in that situation with that bank. And
yeah, there's other stuff going on there, but yeah, that was the main thing.
But one of the things that came out of that was the backstop from the Federal Reserve, correct?
Well, that is the thing that was the most important factor, is that it was discussed on the news and newspapers. The whole world was discussing, what is FDIC insurance? What do you mean my deposits are not insured? Like big tech companies who and big, I think Oprah Winfrey had $400 million there. And they're only insured for $250,000 per person, unless you structure them a little differently, which we can talk about. But yeah, the FDIC insurance is $250,000. So anybody who had more than that in Silicon Valley Bank, that was not insured. Right. So if the bank was going to crash because everybody's pulling their deposits out, all that money would poof, gone. And that's, I mean, a lot of companies had their main checking account with Silicon Valley Bank. A lot of the high-tech companies. It would have destroyed, it would have been systemic, as Janet Yellen called it. But that's with any bank. Any bank cannot, no bank can withstand a run on the bank because they don't have the money. It's out there. It's working for them. And if they match their withdrawals to their deposit requests, that's fine. And as long as more people don't come in saying, hey, I want my money out. And then when that perception gets out there, when people understand, holy shit, the bank doesn't actually hold my money. What the hell? They run to their bank, and that's why they try to keep that out of the news. The amazing thing during Silicon Valley Bank and those other banks was it was in the news. Yeah. And now people are starting to question, what is FDIC insurance and why do I care?
And partly things that I saw in the news that started to circulate were conversations like this, where if you guys haven't seen this was a conversation. I think it was one of the senators of Oklahoma or something like that was basically asking Janet Yellen herself, if you guys, what creates a bank from being called systemic, where you're going to come in and you're going to backstop. Is backstop the correct term to use for there?
Well, the real thing they discussed is whether or not the U.S. government through the FDIC or the Fed or whoever is going to bail out unsecured creditors, unsecured depositors. And what Janet Yellen said is only under these certain circumstances that it's a systemic problem that would have the capability of destroying the entire system. That's why they bailed out. They say they bailed out Silicon Valley Bank and Signature Bank and the other banks. And then the senator says, "Well, what about my bank in Oklahoma and my constituents, farm banks, the small banks?" And she kind of danced around the subject because she didn't want to say. I think she did say, "Well, if they have $250,000, that's the FDIC insurance per person per banking institution." But what about companies that run like John Deere tractor might be running out of Oklahoma, have $20 million in the bank? Would they lose it all? And basically, she didn't answer the question, because if she had answered the question, it would have put a marker, a stake down, and it would have called into question this Ponzi scheme. It really is a Ponzi scheme, but it's a structural Ponzi scheme, because all the bank investments are out there. They're there. They just can't cash them in instantly. So if you want your money, you can't have it. If you want to wait 30 years for these investments to fully, we get all our money back from the investment, you'll get your money, over time in 30 years. And nobody wants to do that. So had she answered the question, yes, we will bail out your bank, that would, I think it's 90 to 95% of all the FDIC insured institutions, 95% of it is uninsured deposits.
Mm-hmm.
And we do know the FDIC has about, I think they had $128 billion, but they insure trillions. I think it's 18 trillion. So even if, and that's just the uninsured deposits. So it's a point where they don't want to answer these questions. I mean, the senator in that instance ends up saying, so my bank doesn't get a bailout.
Mm-hmm.
And then Janet Yellen doesn't answer. She says, $250,000 per person unless they're systemic. And he's like, okay, so these big central Silicon Valley banks, these big JP Morgans and Bank of Americas will get a bailout, but the small banks who were doing pretty much everything a lot better than what the big banks are doing, they don't get bailouts.
Mm-hmm.
And I would argue, personally, I would argue that if you don't bail out one small bank, that's systemic, because everybody will look at that and say, oh my God, they're not covering all uninsured depositors like they did with Silicon Valley Bank. And that's what we're coming up to. There's going to be a couple bank failures coming up where they say, how do we claim that this is systemic? But it's all systemic because of the visual part of it. People will all of a sudden understand that their deposits are at risk. Any third party that holds your assets, you're at risk for that party staying solvent.
So do you think that if that becomes visual, if people start to realize that, it's going to push everyone out of the small banks and into these large deposited safe banks that are systemic, right? Is that what's going to happen, you think?
That's what has happened.
Mm-hmm.
But here's the rub, and the rub is these large banks.
Hey guys, unfortunately, we're going to have to cut some of this video out. The conversation that Bix and I got into was a little bit too controversial for this streaming platform. So if you want to get the whole uncensored interview, please go check out our Patreon channel. It's only $15 a month, and you'll be able to get the entire uncensored interview of this talk and also all of our other talks that we've had in the past. So please go check that out if you want to get the full scoop. Now let's get back to the discussion. Something you said there that I really want to touch on, because I agree with the fact that we are moving away from this unbacked fiat system that we've been under for so long, because it's really coming apart at the seams. And it would be ideal if we move towards a sound asset based currency or financial system. For example, cryptocurrency, for example, gold or silver backed currency. That would be the ideal.
Not backed.
Not backed. Like actually using the physical metal to trade with.
Yeah, absolutely. And I mean, you can issue new bills from the U.S. Treasury that say redeemable. For a redeemable currency would make sense.
That's what I meant by backed. So if we use the Treasury note that actually had, you could go in and turn in that note to a bank or something, and they'll give you the metal back. That's not backed. That's just redeemable.
That's redeemable. Backed would be what we had from 1934 to 1969, in that time frame when Bretton Woods fell apart. That was a backed currency. You weren't, as an American, you weren't allowed to own gold. Mm-hmm. And citizens couldn't, which is the craziest thing if we think about it now. But theoretically, the United States was backing the currency with gold all the way up until then. And then France said, what the hell? You're creating more money than you have gold. We're going to call in our gold. And that's when Nixon took us off the gold standard in 71. But see, that's why it won't work anymore. It was a promise. It was a faith-based system. Any backing, like if the Chinese said, we're going to back the yuan with a tenth of an ounce of gold, if it's not redeemable, no one would believe them.
Okay, and that's the part. It has to be redeemable. And when you say something's backed, that doesn't mean redeemable. That's
correct.
A good clarification. I didn't realize that. So that's the ideal. We're moving toward, I think, silver redeemable, gold redeemable currency out of the Treasury, not the Fed, not a central bank, or something else that's totally decentralized, like cryptocurrency, Litecoin, for example, would be a really good example of that. That would be, I think, the ideal financial system that we'd go into. But that would be for us. That would be ideal for us. For the governments, for the powers that be, that's not the ideal situation, because then they can't really control the markets. They can't really control us and how we spend. And that's what the argument I hear a lot in this space coming up is, they're going to try and push us in the other direction, which is towards a centralized bank digital currency, or a CBDC. And we're starting to see that a little bit more now with the rumblings of, here in America, the Fed now system. And we've even seen it internationally with countries like, I think it was Nigeria, trying to start a CBDC, and it did not go as planned. And I wanted to ask your opinion. How does you first believe that's where they're trying to push us? And then if that is ultimately where they're going to push us, do you think it'll be successful?
It's complicated. I mean, obviously there are people within the banking system, so they're not going to be deciding what the future is. Now, the Fed Now coin, or not coin, the Fed Now system, the banks should hate it. It's a banking system that you don't have to use the banks for.
That's right.
So, yeah, and that's scheduled to come out in February, January, or June.
Right.
And truthfully, I think it has to do with linking the Gold and Silver Eagle program to
Really?
a new Fed currency,
Hmm.
because we do know they're making massive amounts of silver and gold eagles, and they aren't selling them to the public. We do know that the back of the silver eagle has been redesigned to show an eagle adding to the nest. That was classic.
Right.
It was done in 2001 when David Ryder was the head of the mint. And Ventures Gibson claims they've massively expanded the Silver Eagle program, except she's only selling about a third of capacity to the public. It's like, okay, you expanded the program. Where are all these Silver Eagles, and what are they doing? And anybody who pays attention to the monetary situation knows the system's going to crash.
Oh yeah, for
The old
sure.
system's unsustainable. I mean, that's why the bankers are talking about a CBDC, is they know there's a massive collapse coming.
Hmm.
And they would love to be the ones in charge. But like I said, they'll be the ones hanging from the street poles. And then, there will be no deciders in the U.S. government. There'll be no deciders in the U.S. Treasury, because they're all part of it. So, yeah, I do think that the day of deciders will end. So what do you do? I mean, we have cryptocurrencies, which I think will do well, but there won't be any exchanges to know the value, which is going to be a problem.
Hmm.
If the banks shut down, all the exchanges shut down too. And then you've got, we do have on the books of the United States of America gold and silver as money. It doesn't take any deciders. It takes rememberers. You got to remember what money is in the United States of America. So there's a lot of shit coming down. So, I mean, I've been screaming it for so long: in your own possession only. If things hobble along, great. They're going to hobble along. But ultimately it is not going to hobble along. We have to get rid of $2.5 quadrillion worth of derivatives for us to move forward. And there's no way to do that except destroy the entire system.
Right. And that destruction of the system is a sloppy one when it comes to the average person who isn't paying attention, which is majority of the people by a lot. And Paige and I actually got into a really good discussion about this morning, is that from the education that we've gained through you and the community around us, we really do believe that a cryptocurrency is one system that could really, really benefit everyone if they were educated on it and they knew how to use it, and they can get their crypto into their own hands. The thing is, probably speculation here, most people aren't going to do that until it's too late, or they're going to have to go into the new system that's existing. So the transition into a new system is going to be a hard one. And that's one I know that you've been arguing with tons of people in the space for a long time, if we should just rip off the Band-Aid or if it's going to be a slow trickle. And I think that really all we can do is try and educate people around us, try and get people up to speed with first of all, what's happening, what's the problem, what's the issue, make them see that maybe your money in your bank isn't safe. Maybe all of the things being held in your retirement or in your investment portfolio aren't totally there or aren't totally yours. That's the first step. And then hopefully be able to provide a solution, which, as we all like to talk about in this space, specifically is getting your assets into your own possession. And what does that look like? We really like the physical assets of precious metals. We really like the peer-to-peer transaction, holding your own asset, cryptocurrency, blockchain based assets as well. The good ones. There are plenty of bad ones. So if I would give any, this isn't financial advice at all, but if I had to tip a hat in any direction for people, it's just to become aware of this situation and become aware of potential solutions. And that's what we're doing here. Do you have any thoughts on, as we wrap this up, is there anything that you want to just leave the listeners here today to have a little bit of hope or a little bit of direction of where to go when it comes as we near this, coming collapse?
Definitely get your assets in your own possession. I know it's hard for some people to even wrap their mind around it. Small to medium-sized businesses, what are they going to do when they lose all their money in the banking system? Or if the Fed bails them out, you lost all confidence, they'll lose it anyway. That type of thing. I do think gold and silver, especially silver, is going to run so high and put such a spotlight on the true problem of money creation, which is they have controlled the prices of gold and silver for over 100 years, just because you have to control the prices if you're going to run an unbacked fiat monetary system. By controlling prices, you take the canary in the coal mine out of the coal mine, and you prop up, you put some mechanical canary in there that can smell the methane gas and not die, and you won't know until you're dead. That's what has happened in gold and silver. The canary has been replaced with an electronic canary that was put there in 1913, and they've been rigging the price of gold and silver ever since, such that you can't figure out why you're paying $5 for a cup of coffee today, and it'll go to $50 and $5,000. It happens very fast unless there's a crash. Now, where we are now is a direct consequence. The chaos that's going on, direct consequence of market rigging, in my opinion. And because we didn't have the historical canaries to tell us there's something wrong, what they use is warfare. The Democrats are the party of war now, which is the craziest thing ever. But that's what they use. When the banking systems are looking fragile, they'll go to war and they'll kill people for it. And then the banks will say, "Oh, it's not us. It's this damn war. It's this damn war in Ukraine. It's whatever war they want to stoke." It's World War I, World War II. It goes back. We fought more expensive and longer wars than ever before in history since the creation of the Federal Reserve System, and that's all to just control the value and the fake facade of fiat money. Mm-hmm. And we're at the end of that now, and I think the education people have gotten over the last 20 years is amazing, and I love it. Crypto has introduced people to an alternative, but also introduced people to really studying what was really going on in the past. And that's great.
And that's one of the larger efforts of what we're trying to do here with the Pebbleton Post. And I know a huge effort that you've done with the Road to Ruta. And so if you're listening now, just continue to educate yourself, continue to understand why we need free markets, because I think a wise man once told me that free markets are the road to freedom. So we got to get there together. And the only way we can is if we help each other out, educate each other, have these conversations. And so keep tuning into the Pebbleton Post. If you think that these conversations are helping you, make sure that you like this video and give us a subscribe, because all we're trying to do here is continue to make these conversations, continue to help people navigate through the changing world that we're trapped in the middle of right now. And so if you like this, also check out our Patreon page, because that's where we're posting the majority of our conversations, the things that we can't always talk about on these other platforms that are controlled. And so please consider following us there and donating to our causes, because that really helps us as well continue to make content like this, continue to have these conversations so that we can all learn something and navigate the change together. So, with that, Bix, thank you so much for coming on, and really appreciate all the insight you always give. Keep fighting that good fight. And for those of you guys tuning in right now, we'll see you on the next one.
All right. Thank you, Josh.